I would like to welcome everybody to this interesting conference. And we start with the presentation. So the first presentation is by Eryk Walczak from Bank of England. The presentation is titled Enhancing the Central Bank Communication with Behavioral Insight, and the presentation is on how to improve central bank communication. So the floor is yours.
Good morning, everyone. Thank you very much for inviting me to talk about our research, which we developed in collaboration with the Behavioral Insights team, our research partner. So I'm going to talk about improving central bank communications using simple and relatable information. So we all gathered here because we are interested in central bank communication. And central bank communication has been changing through years. So in the 1930s, Sir Stephen Harvey, then Deputy Governor of the Bank of England, said about the bank's external communication that it was to leave our actions to explain our policy. And that is a dangerous thing to start to give reasons. We know that things have changed a lot since that time. And we moved from time wherein never explaining to the world our policy to the explanation is the actual policy. And we all know that communication is not easy. And one of the reasons why it is not easy is that there is something called twin deficit. So twin deficit is a term coined by Andy Haldane, chief economist of the Bank of England, who defined it as deficit in both understanding and trust. And this deficit was found in many studies. So here you can see two examples of deficit of understanding and trust. So on the left-hand side, you can see results from a study by OECD, which was conducted in 2016, and it showed the levels of financial literacy across the world. So the United Kingdom is highlighted in yellow here. So you can see there that the average understanding, average financial literacy is below the average of 56% across the countries. Ukraine was not tested, but Poland also scored below the average here. On the right-hand side, you can see results from a poll conducted by YouGov. And in this poll, trust in different professions in the UK was tested. So economists did not score particularly well here either. So as you can see, economists are at the very bottom of the list. Only politicians, members of parliament, and members of parliament fared worse than economists. So how can we communicate effectively if we are not trusted and not understood? Can we improve both understanding and trust? And this is exactly what we tested in our research. So I think the clicker is not working. Okay, so I'll just briefly move on. Okay, thank you. So our research objectives were the following. Our main question was answering the question, how can central bankers improve their communication with the general public? And specifically, we wanted to know whether existing inflation report summaries, the ones that Bank of England put on its website, are effective, and how these summaries fare on comprehension and trust. We also wanted to isolate the effects of visuals, of icons, of length, word count, and readability. So how easy it is to read actual text. We also wanted to evaluate the impact of new interventions. So we wanted to see whether we can improve the existing summaries by making them relatable to people's daily lives. So instead of talking about abstract concepts, we wanted to introduce examples from real life, concrete examples. So we did it in the... So here are the findings, summary, and implications. So to sum up, we found that visual summary improves public comprehension, and it improves public comprehension relative to the monetary policy summary by 25%. So this is a large improvement. We also found that making visual summary more relatable by implementing those changes that I mentioned earlier, we were capable of increasing public understanding and trust in policy messages. We also found out that increased readability improves comprehension. So how did we find out all of this? We tested existing and new inflation report summaries, which were published by the Bank of England in February 2018. And we tested them using large-scale online experiment. So we tested over 4,000 participants, and our participants were a representative sample of the UK population based on gender, age group, income, and regional location. So we wanted to make sure that our results can generalize to the broad population, not only testing students, but testing people from all demographic groups. So we tested the following summaries. So the first one, the original monetary policy summary, is very texty. Here you can see an extract from the monetary policy summary from February 2018. And as you can see now, the summary is very long, and it is written with economic financial professionals in mind. So language used is very technical, and it requires graduate level reading level. The improved version, well, the new version of the summary, of the inflation report summary, is the visual summary. And in this version, language is less technical, more readable, and it requires a reading level of adolescents. So, on top of changing language, simplifying the language, we also added icons that summarize text and summarize main messages that we want to convey. So to compare both summaries, you can see this particular table, and here I provide an overview of different variables that we measured. So we looked into word count, so total length, which, as you can see, is actually longer in visual summary because it required slightly more words to explain certain concepts in a manner that was relatively easy to understand for the general public. We also measured something called Flesch-Kincaid grade level, and this is a well-established metric of readability, which takes into consideration average sentence length and average number of syllables. So here you can see the grade really that is required, US grade that is required to understand a particular text. So monetary policy summary requires graduate level, reading level, visual summary is pretty much accessible by adolescents. And last variable is visual elements, so the icons that I showed you a moment ago. So we tested these summaries in the following way. So we used Predictive Platform, which is a platform for running online experiments, which is developed by our research partners, the Behavioral Insights team. And using this platform, we could access over 200,000 people in the UK. We also obviously tested much smaller sample, 4,000 people here, but we were able to create a sample that was representative of the UK population. And here you can see the order of the experiment going from left to right in different stages, from 1 to 7. And our participants started with seeing the instructions. So instructions were relatively simple. They explained what the experiment is going to be about. Then in the next stage, participants were randomly assigned to one of the summaries, one of the experimental conditions. So in our case, either monetary policy summary or visual summary. And participants would be presented with a website layout. So the summaries would look exactly the same as they are presented on the Bank of England's website. Once the summaries were read, we asked our participants a series of questions. So we asked about self-reported comprehension. So we asked whether they understood what they just read. Next was a question, we actually tested if the participants actually understood what they read, and we asked several questions about interest rates, inflation, unemployment. So here there were 5 different questions, and that was our main dependent variable. So that's what we're mostly interested in. So this is going to be focus of this talk. Later on, we tested something we called applied comprehension questions. So we tested whether these abstract concepts like inflation could be applied in new settings. So we introduced the idea of inflation in the summaries, but we also wanted to see whether our participants can apply this concept in setting of understanding changing prices or changes in salaries. Next set of questions were related to trust. So we asked our participants whether they trust communication that they were just presented with, and we also asked them how has the inflation report summary affected their perception of the Bank of England. We also collected additional participant profile questions, so we tested how well acquainted our participants were with economic literature. And our participants were actually incentivized to answer those questions correctly. So we not only paid them for participation, but we also paid them depending on the number of questions that they answered correctly. So here you can see the examples of the direct comprehension questions. So as I mentioned previously, we ask our participants about issues that are key issues for the Bank of England, and answers to all of these questions can be found in both summaries. So as you can see, we ask about changing prices, unemployment, interest rate, and so on. So here in this particular variable, participants could get maximum of 5 points by answering all questions correctly. So before we started the experiment, we conducted something called power calculations. So by designing the experiment and collecting data, we wanted to be sure that by running this particular experiment, we'll be capable of finding the actual effect. And we knew that we'll be able to spot relatively small change in comprehension levels. We also checked the attrition rates. So we wanted to be sure that participants did not drop out from different summaries at a different rate. And we wanted to be sure that different demographic groups are represented equally in all summaries. And we found that there was no difference between the groups here. So on this slide, you can see the actual results. So that's the main result of the first experiment, in which we tested existing bank summaries. So monetary policy summary, the standard bank summary, and the improved version, visual summary, simplified version. So here you can see the improvement of around 25% in terms of scores, the comprehension score. But what is quite interesting is that overall levels were relatively low anyway, but this is not so surprising. That was found in other studies as well, from studies on adolescents to adults across the world. But what is even more interesting, what's striking, is that we managed to improve the number of people that understood most of our questions. So in the first group, in the monetary policy summary, only 12% of people were able to answer most questions, most meaning 4 to 5 questions. And in visual summary, this increased to 27%. So this was quite a dramatic change. We also looked at other dependent variables, so dependent variables being trust, self-reported comprehension, and so on. And we found the same effect in self-reported comprehension and perception of the Bank of England. So we knew that simplifying language and introducing visual elements made a difference here. So people also believed that they understood more, and they actually did understand more. There was no effect on trust and on applied comprehension in here. But as I mentioned previously, we had several variables that were changing at the same time, so it was quite difficult to pinpoint the exact reason for these particular effects. So we developed next experiment where we controlled the word count, the reading rate, and the visual elements. So the follow-up study, experiment 2, we reused the monetary policy summary. So here you can see this in the top row. So that's exactly the same as in the previous experiment. And we developed new versions, slightly edited versions of visual summaries and monetary policy summaries, in which we kept the word count constant. We made sure that the reading rate did not differ significantly between those summaries, and we also manipulated the presence or absence of the visual elements. So we used what we called visual summary previously, but without visuals, without the actual icons. And then in the third row is the monetary policy summary, which used the icons that we showed previously. So the results from the second experiment were the following. Using modified Banque summaries and controlling for length, readability, and visuals, we found that the only difference between the conditions that made a difference was readability. So here you can see that in both cases, where summaries were presented without visuals on the left-hand side and with visuals on the right-hand side, it was actually readability that made a difference. So when we tested both monetary policy summary against each other, so black versus black and blue versus blue, in case of visual summaries, there was no significant effect there. So readability was driving the effect. We're able to isolate this effect to understand how we can further improve those summaries. So once we established that readability makes a difference, we also wanted to know whether we can further improve our communication by using shorter version of visual summary, which is highly readable, and something that we called relatable summary, so a summary with relatable elements. So by relatable, I mean several modifications. So we made changes to the visual summary that introduced real-life examples, that introduced some linguistic changes and personalization. So here you can see example of these changes. So on the right-hand side, there's personalization. So we ask our participants to choose unemployment rate in their particular region. So we did not give them just overall UK unemployment percentage, but we also allowed them to check their particular region. We also presented real-life examples, so instead of talking about abstract concept like inflation, we showed an example of receipts, so explaining how the cost of grocery shopping would change. And we introduced linguistic changes like using first and second person pronouns, so we're talking about us and you instead of Bank of England, and we used more familiar, less technical terms, so we talked about prices instead of inflation. And the results here were the following. So we found that making our summaries relatable improved comprehension even more. So we know that this effect was significant, and more people that were assigned to this relatable summary answered, on average, more questions correctly. And the same effect, the same direction of effect was observed for trust and applied comprehension. And in this particular case, in this particular summary, we were able to observe this effect on trust, and that was the only case where that was possible. In all other versions of summaries, we did not observe any difference between different summaries. So to sum up, here you can see the overall regression table, and we found that it was readability, so first blue columns made the difference, and then relatability made the difference for comprehension. So to sum up, key takeaways for policymakers are the following. Well, you can improve readability and visuals and make the summaries more relatable, because this is something that seems to be making a lot of difference. It's improving comprehension. We know that visual summary improves comprehension of the main messages compared to monetary policy summary, and we know that this improvement is driven by increased readability rather than the inclusion of visuals. And we also know that comprehension can be further improved by making the examples relatable to people's life, to talk about everyday concepts rather than abstract ideas. So in the future, we would like to study more increasing engagement and maybe unpicking relatability, but we believe that even these takeaways are very important for understanding communication and to improve communication by central banks. So that's it. Thank you a lot. Dziękuję. And I'll take questions.
Thank you for perfect timing. And now we move to the discussant, Klodiana Istrefi from the Banque of France.
Good morning, everybody. It's a great pleasure to be here in Ukraine and to discuss this paper. It's very interesting. I hope I have my slides. So, microphone? Okay. It went too fast. Okay, so I'll start by, I'm not going to make a summary of the results. I will start directly with my comments. So my first overview of the paper is that I find the paper valuable for at least 3 reasons. And the first reason is that it's not very common to see experiments that relate with central bank issues. And I think that Bank of England especially is setting up a very good example. There have been a previous experiment by Michael McMahon and Andy Haldane. That is, Michael is here. And this is the second example, and it's very good. And I think we're going to learn a lot if we continue on this tradition. The second valuable point is that findings make sense. It's common sense. If we are going to speak to general public with a clear and simple language, most probably we are going to get their attention. And the third point is that these findings are not specific only to one type of communication, as the case here is the inflation report, but these findings can be generalized to other types of central bank communication and to other central banks. So it's not only for Bank of England, it's a lesson for all central banks. However, I'll have 4 points that I'm going to comment. The first point is a bit more general. It's on the desirability of central bank communication with the general public. And I'm going to mention there are 2 caveats that we should have in mind when we think about how to communicate with the general public. The second point is on the comparison of treatments and their result. And I have another point on perception and trust, and a fourth and a final one on the experimental design. So let me start with the desirability of central bank communication with the general public. And it's not only with the general public. Central bank communication, it works if it fulfills at least 2 conditions. One, it is precise and clear. And twice, if it's simple, especially with the general public. But is it always so? Are central bank communication always precise and clear? Well, unfortunately not. And I'm going here to mention just one example. There may be many of them. And this example is a taper tantrum that the episode that happened in the US due to Fed communication. Ben Bernanke, he was talking about the future of asset purchases, and markets reacted in a very volatile way. Long-term interest rates increased. What was the opposite what the Federal Reserve wanted at that particular moment. So the idea was what happened? One is that maybe this was poor communication. And FOMC members themselves, one meeting later, had a long discussion about our poor communication actually is working against our intentions. So it's going to undercut the effectiveness of our own policies. And today, Michael Ehrman will present as well research that shows that poor communication is worse than no communication. So this is the case here, that central bank communication is not always good. So we have to keep this in mind. Now we're getting the attention of the general public, and they are not always going to get good communication. The other point is that that was another FOMC member at the time. He said that maybe central bank communication was not that bad, but market is not a single person. There is a diversity of market participants. So there is heterogeneity in their views. And if we are going only to look at the median expectation, maybe that we are kind of communicating to the median guy, but not to the diversity. Now imagine adding to this listener the general public, which have even more diverse views, they have even more diverse expertise. And imagine the general public listening to this taper tantrum episode. So what would have happened if they were listening and acting to that too? The other point is that it works if it is simple, but how simple can it be, central bank information? Central bank information is not simple. Let me show you the Bank of England inflation report, or what is studied in this case. So if we look from the first layer, which is the usual summary, to the last layer, we see that the text has been reduced. So we go from 1.5 pages to 2 paragraphs, or less than 2 paragraphs in the last one. Readability has improved, so it's easier. Relatability has increased also, but complexity has been removed, uncertainty as well. So here I listed, you don't have to read the table, but for each treatment, monetary policy summary, the visual one, the visual reduced, and the relatable one, I listed the economic words that are mentioned. So if we go from the first to the last, so in the first we have at least 40 economic concepts that one has to know to understand the text. In the last is only 10. So there is a lot of complexity that is reduced. So in the last summary, we're talking only about 1/4 of information that we are talking in the first case. And with that information, uncertainty has been removed. There is a lot of uncertainty about Brexit-related uncertainty, economic uncertainty, financial volatility, and so, and nothing is appearing in the last version. And why is this important? It's important because by removing complexity and uncertainty especially, we're risking to lock the general public on one baseline path. And why is risky to kind of make them believe on one baseline path is that we risk losing the credibility if this baseline path is not materialized. So here I just want to raise the question, what should we communicate to the general public? Objective, decision, expectations. And if we want to communicate expectation, then I think it is important that we don't forget to communicate uncertainty. And In this respect, central banking communication should be simple, but not simpler, because things are not as simple. My second point relates with the treatments, which I think the treatments are very different. I explained to you the idea of complexity and simplicity, how we go from one treatment to the other, but the results are not so different. And another reason that works in favor of the last layer, the relatability, is that questions in this test are framed in the language of the last treatment. So comprehension scores are not varying that much. At the end, they are really getting 2 points, two questions right. So I have some guesses what is happening. This is really guesses. So my first guess is that maybe participants in these experiments didn't read, most of them didn't read the summaries. Why I say that? In the working version paper, it is written that it took participants, the median participant, took 1 minute and 20 seconds to read the text. It struck me very low because the first text is really 1.5 pages. I read it myself, it took me 5 minutes. I gave it to my colleagues, 3 other colleagues, it took them 5 to 6 minutes. Then I read the visual one, it took me more because there are graphs, there is more text and graphs. I spent time looking at the charts as well. The last one took 3 minutes. So this makes me think that these people actually just started reading and then click next. They went to the next question. There are 2 questions that there was no difference across treatments. They did equally well or bad. What are these questions? Is the question on the actual policy rate, which was 0.5%, and the question on prices, the change in prices. And the right answer was that prices rising faster than the bank's target. So let me think. So my question is, what did participants know before? So before reading these treatments, these summaries. And I looked at the policy rate at Bank of England. It has been 0.5% for almost 7 years. So the question is done at this period here. It refers to the period where I put this yellow line. But you can see that for a long period, interest rates were 0.5. So here I wonder, maybe they know the 0.5 from the past, and it was not something that they learned in the text. I don't know. This is a guess. The other thing is that they responded right to prices rising faster than the bank's target. But we all know that this is generally the case, that households' expectations are usually higher than the actual inflation. They are always going to overestimate inflation. So maybe they got this by chance. I don't know. If the treatment or the experiment had designs that ask what is their understanding before reading the summary, we would know more. So what did they know before readings? And this before and after evaluation would be telling. And the other thing is that if they didn't know anything before and they read the text and they got at least 2 right, I think this is a success because they spent 5 minutes and they got 2 things right. And we have to get people probably once in a month give us these 5 minutes. So this would be a very good result. The other point is about perception and trust. So the experimental design is for people to read some information, and then the objective is to get from them perceptions on the Bank of England and the trustworthiness of the information. And results stayed the same, and there was a slight improvement with the last treatment. Now, I wonder what matters for trust. Here they read words. Is it words or deeds or both? I don't know that. And here we could have asked them what they knew before. What were the ex-ante perceptions about Bank of England before they entered into the experiment? And I have a proposal for the authors to use a so-called implicit association test, which gets the perceptions of people on the Bank of England in this case, without their knowing that actually you are asking about the perceptions. It's an implicit. So this is a way to get them answer something without really knowing that what they are answering for. And I let the authors read the details. And last, participants. So we learned that by making the text simple, they might get it, but we don't learn much about participants. I wish we had learned more about them. What is their education? What is their cognitive abilities? What is their financial literacy? Because what can we do next? We simplified information, but what else? We know that a lot of central banks have engaged in this educational program. So are they understanding more if they are more financially literate or if they have higher cognitive abilities? So I would like to know that. There are some details that are missing, so, and I would wish for these details to be in the paper, and they are in the working version of the paper. And last, I would like to conclude with these remarks from Alan Blinder. In 2017, he was making some predictions about communication, and with respect to communication with the general public, he said that central banks will keep trying to communicate with the general public as they should, but for the most part, they will fail. Now, this paper is a great example showing both that central banks are trying and maybe it could work. There are ways that it could work, and one way is by talking in a clear and plain language. And I would like to finish with a quote from former Vice President Al Gore, which was really putting some efforts for the government, for administration, to speak in a simple and clear language. And he said that clear language is a civil right. And I think that we as central bankers should respect this right too. That's all.
For some questions, maybe before the response, we can collect some questions from the audience, possibly. So if there are some questions. Mm-hmm.
So one question that I have is whether this visual statement would be, a relatable statement, would be as a supplement or as a substitute. Because here in this talk, we've talked about comprehension of the public, but the statement will be read much more by finance professionals, and it's also important to figure out what they learn from the statement. And so if it's a substitute, that potentially could be a problem.
Maybe one more question here.
Let me introduce myself. Miroslav Singer, I'm vice-generale. I was a governor of Czech National Bank. I'm puzzled by, you've been paying the participants for good results, correct? But is increasing the motivation? But I do not think the general public is really motivated only to understand the central bank communication. It is motivated to have emotions. It has a much wider set of motivation than just understanding. And I think you might be, in a sense, increasing the importance of your result by this too much.
Maybe one more question there. So, if it's possible, quick question.
I'll be quick. Yeah, I want to echo a little bit Klodiana's remarks on the possible trade-offs here. I mean, I understand there's sort of many central banks are thinking, how can we reach better out to the general public? But I think this does come at a cost. So, Klodiana put it very nicely. We talk less about uncertainty. And I think one dimension that you haven't been covering here, in the real life, 800 words or 1,000 words would fall into the category of TLDR, i.e. too long, didn't read. So if you really want to reach out to the general public, you need to go to, say, 50 words or 100 words. And where do we stop? I think we need to think about an objective function. What is the trade-off that we are willing to actually face in terms of simplicity, shortness of the message, as opposed to the complexity that we do want to communicate? And I think that's really first order for us to think about how far we want to go on that journey.
And we have 3 minutes for answers.
Sure, so I'll answer first the questions from the audience.
I have questions, maybe.
Do we have time for another question?
Yeah.
Okay.
Sorry, I don't think we have time.
Okay. So the first question about whether it's the visual summary, whether it's a supplement or a substitute. So in our case, we just believe that, well, participants or readers really can choose whichever summary they want to read. So both versions are available on the website. So I think that readers can self-select pretty much whichever version they prefer. So finance professionals or people who are used to this kind of language can read the monetary policy summary. Everyone else can read a visual summary, but also participants who are used to reading difficult materials actually benefit from simplified language. So it's not necessary that general audience should be served with these simpler materials, but everyone could actually benefit from simplifying text. And well, this is actually touching on one of the questions that Klodiana had about the time that people spend reading. So we know that to read the summaries, it would take much longer that participants actually spend on questions, but when we looked at the results from the website, Bank of England's website, the results were quite similar to what we had in our experiments. So a lot of people would skim read through the summaries. So very few people would spend a lot of time reading those materials. So that's another reason why simplifying can be quite useful, and using some kind of icons or examples that pop out and that make us inform the readers much more. And the second question was about paying to our participants. So the payment was relatively low for the questions, and that's a common practice in psychological experiments. So you pay your participants, but not too much to make the motivation external. We still want them to be motivated by the fact of getting the answers right, but the remuneration was not high enough to overshadow the intrinsic motivation. And this is a standard practice. So the third question was about trade-offs, about whether we should use long text or not. So in the last pairwise comparison, we used shorter versions that were less than 500 words, so they were relatively brief. But as I mentioned, full versions, full summaries are available on the website. So if readers want to delve into details, they still can do it. So we're not postulating replacing totally the existing summary, but having different options as well. So that would answer the question. Maybe I'll just address one or questions that Klodiana raised about testing our participants before and after the experiment. So we considered that initially, but eventually we decided not to do it, because by asking participants before the experiment, we could prime them, so we could let them know what precisely we're going to ask. So a standard procedure is not to do it. And we knew from other research that the general understanding is relatively low. And points that you raised about lack of difference in particular questions, we believe that it's not necessarily because participants knew the interest rates before the experiments, but it's because the actual interest rate was really highlighted in the summaries. So there was a large box that would say that interest rates is set at a particular point. And we, as I mentioned previously, our participants came from all sections of society, and we wanted to be sure that our results are generalizable, but we also saw some differences between different groups. So we knew that different parts of participants performed better than others, but I did not include it here, just for brevity. And I also should have mentioned that 2 of our questions were actually based on Andy Holding and Michael McMahon's paper, so I should have given them credit earlier on. So I think that's probably it.
Thank you. Please join me in thanking the author of the presentation. And our next presenter is Michael Lamla from University of Essex with a presentation titled Central Bank Announcements, Big News for Little People, and the presentation about how central bank announcements affect inflation expectations. The floor is yours.
Thank you. Allow me to start by thanking the organizers for having me here, inviting me to Ukraine and to this very, very exciting conference. As you see from the title, I would like to talk on the effects of central bank communication on consumers. So I'm not focusing on what's the optimal way of communicating, but focusing on the very basic questions. What, at the end of the day, happens to consumer expectations once you have this press release? So how much do they get actually from this? How many are influenced by this press release, and what does happen to this? So why is this interesting? Well, first of all, if you look in the literature, you have tons of papers on financial markets. So you know quite a lot already how financial markets respond to any type of communication central banks are doing. But there is very, very little evidence on consumers. And the problem is that this little evidence shows us that consumers are not really behaving as professionals. So you don't just can translate all the results we got from professionals to consumers and be happy with this. So you have to do a bit more. And therefore this quote by Blinder, which is already quite dated, still is valid, because we have very little evidence on how consumers behave. And there are basically, I guess to my reading, two main reasons. Well, there is some data out there in surveys, but, well, they talk about some kind of expectation, but if we want to focus on central bank communication, they're not always all the questions we want to ask in those surveys, because they're usually generally based. And second, and this is more important for our kind of analysis, because we want to look at the effect of a special event in time, there's an identification issue, right? If you're unlucky, and you take, for instance, this consumer survey of finances in the US, it's every 3 years. If you get another consumer survey like the Michigan survey or the New York Fed survey, it's month to month. But the announcement happens on one day, and there are a lot of things happen in between those. So inferring from changes in expectation between months, well, you might be lucky to get part of the information right, but you could be wrong, because there could be some other things happening during this month between two communication events that then are blurring the overall effect. So you cannot be sure that what you get out of it is the right announcement effect. But there are some silver linings, some hope to this, and there's some fresh wave of papers taking tremendous effort collecting new data in some quasi-experimental design to shed some new light what to do, what communication can be, how communication is influencing, which type of communication is very effective. We have the paper by Korbion, Gorodnichenko and Weber, where they treated in a very large, I think, over 80,000 observations survey, different type of communication bits and pieces. We have Haldane, the paper by McMahon, which is now the third time I'm referred to this, and rightly so, on randomized treatments on economic students. Eryk just papers, a similar line of papers. That it's now moving forward, closing the gap what central banks should be doing related to consumers. And our paper is in this line of papers because we also generate a new survey, because we cannot use the existing ones. We try, or we explore innovation, perceptions, and expectations, so the standard ones, but we also look a bit behind this. We look at confidence, or how confident are people in those kind of forecasts they are doing, or perceptions they are having. We take the information set very seriously, because we don't know how many already knew something about central banks or have been aware of the announcement of the Fed, of the Bank of Ukraine, or some other central bank. So we take care that we know which individual we are serving knows something about or was aware of this information that was spreaded. And finally, we take good care of the sound identification. Because instead of waiting 1 month after another and hoping that there are not many events in between that might blur the overall effect, we survey consumers just before the announcement, then the announcement happens, and just after this. And I think this, in terms of high frequency, this is as much as high frequent you can get in terms of consumers. So just to make things clear, we are looking at the Fed since October when we started this. Fed had several meetings during the year. 4 of them are with a press conference, so we have also one version without a press conference, but mainly we focus on the press conference versions. And the press conference is standardized on a Wednesday, so we initiate the first wave on the Monday, so it goes out. Then we get all our answers back until Tuesday morning usually. Then we have the Fed announcement together with the press conference. And on the next day, so the Thursday, we start the second wave, which is then collected by the Friday. So, as you can see, if you target this narrow window, you need some kind of new technology to conduct this. So we sought to an online survey system provided by SurveyMonkey. They again guarantee that we get a random sample of the US population. We have a nice incentive scheme, which I personally like. I mean, there's a whole literature on how you should incentivize people. We had one now with, Eryk did one with money, which is quite standard. They are doing this also with money, but you can then choose a charity. So you're not getting the money yourself. Once you've finished our survey, you get an option of different charities, and then you can donate to a charity. So at the morning, while you are typing this on your iPad, you can do something good and improve your karma. So this is something I personally like, but of course this is debatable. Then in terms of size, we roughly, this is the minimum level, target 600 individuals before the announcement and 600 afterwards. We usually get a bit more, but this is the minimum SurveyMonkey guarantees us. And the last one, and I think this is the most important bit why we resorted to SurveyMonkey, is the speed. So within quite narrow amount of time, you get a lot of responses. So within, this is an average we calculate, within 6 hours we get roughly 400 responses. So we are really quick after the announcement to get a lot answers, a lot of individuals with the same or rather similar information set. We can even control for the time or the time length, so we can really sort them. We get a lot of people with roughly the same background in terms of where they have been collected. In terms of data, we collect, of course, the most important bits we're interested in. So we look at inflation, past and future. We look at some kind of interest rate, past and future. We try to infer how confident they are. There are different ways. You can work with some probability distribution and count for specific probabilities to specific outcomes. We basically just ask them, are you confident, yes or not, very or not. I think we should play it simple when you're working with consumers. And then one important feature, whether you have heard something about the Fed. So in the first question we ask them, have you heard something in the last week? And the second one, we just, have you heard something yesterday or the day before? So we can really pinpoint where they got the information from and if they are informed, right? Remember, we're talking with consumers. Some people might be just completely ignorant about any communication by the central bank. So it's not trivial that we ask this question. And you will see later why. Then we get plenty of individual characteristics we could control for. We get gender, age, region, income. We have ideas about risk and ambiguity attitudes. We can explore financial literacy. And we also collect some kind of financial decision making, so to get some idea regarding possible or potential implications. This is how the data looks like. Not sure you see it. So this is the data on inflation. The first row, past and expected. In the second row of graphs, you see the interest rates. As said previously, well, most of the observations is between 0 and 5, but if you do the kernel density plot, which is the red dashed line, you see, well, people overshoot. They have higher expectations than what professional forecasters are expecting. They have also higher perception than what is realized, and quite substantially higher. Right? So it looks roughly okay. It looks certainly okay with related to other surveys we've been doing, but you see the patterns also in terms of focal points. If you look at 5%, 10%, 15%, you see people that they are ticking more frequently these kind of boxes. So they are high means. The question is then, should this bother you? Of course, they should bother central bankers if people have high means. But the question is this mean the problem, or is this the movement over time an issue? And if you do some correlations with past inflation, what we surveyed, and the CPI, you see the correlation is quite high, so this gives you some assurance that why they are not aware of the mean in terms of movement. They are roughly okay-ish. With the future, it looks not as much, so we compare the correlation of expected inflation they report against a survey of professional forecasters by the US. So this is the reference point we take, and the correlation is 0.3. So there is some positive correlation, not huge, but there is some link to this. In terms of the other data we have, well, confidence in the past is a bit higher than confidence in the future. Makes sense. Announcement means basically that we have roughly the same population that has been before the announcement, so surveyed before the announcement as surveyed afterwards. Gender is roughly balanced. Age and income is roughly balanced. I compared this to the Nielsen home scan data. It's looked quite similar to this. One highlight I would mention now is the news fed. So this 35 means that 35% of our surveyed consumers reported that they have heard something about the Fed. The Fed is doing something, which, well, is not a lot. Well, it's expected, well, it's not a big surprise, but it's not overwhelming. And remember, we are just working on the week where there is an announcement. And if you look at news, how the amount of news in this week is distributed, you see already elevated levels of news before the announcement, because you have all the experts coming out and talking, well, what potentially the Fed will be doing. So it's already peaking up on Monday and Tuesday, and then it goes even further on Thursday, and then starts tapering off on Friday. So you have already a week of elevated news on the Fed, and even in this week, we have 35%. This, of course, also implies that we need to think about a bit differently when we're analyzing the data. Right? We cannot just, like, if you look at professional forecast data, you take some exchange rate, you add some announcement dummy in, and then explore how big the effect is. Well, when we're working with consumers, and this is what I think to be doing in the next slide, we need also to incorporate that there could be some situations, if you just do a regression on announcement, that there might be no effect from announcement. And the reason is not because announcements are not relevant, the reason could be just that nobody listened. There was no extra effect on the people, there were no extra news people perceived. Okay? And this is basically what we like to summarize in the kind of, well, it's not a model, it's just a kind of thinking structure we have. We have expectations at the day before the meeting. which is a convex combination of people that have been affected with A, so a share of people that have heard already news before the announcement, right? Some professional forecasters discussing what the Fed might be doing, and 1 minus A, the unaffected, which have the same expectation as before, right? Then we assume this is double I expectation process is a bit more precise because they have already the news from the professionals, and this kappa I sum of potential outcomes on I are less precise because they are my personal or the public average expectation process. The day after, when the central bank announces, we have again a share of people that have been affected by the news directly from the central bank, so with the highest precision. But there are also people out there that haven't heard anything. Okay? And then, if you look at this, then it makes clear that it's not trivial when you run a regression on announcement, on expectation, that there will be always an economic significant impact. Because perhaps the information value was not enough. Or perhaps nobody listened. So you really need then to account for the share of population that was affected or not, and you really need to account for the news. Okay? How big is the news effect if you want really at the end to tell how big is the announcement effect. So what are the takeaways here? So announcement effects, expectations and perceptions if there is some significant news exposure, so if there's A1 is bigger than A2, so more people get informed, and or if news is provided, so there's some additional information coming out, which is of course not trivial if you think about rational expectation models and so on. Okay? So this means, flipping this, it could be that announcements have no measurable effect at all for consumers. Right? If you run a regression, that could be completely insignificant. And it's not something that should vary in the first place. It could be, well, it's of course worrisome, because apparently people don't listen, or you are not communicating in a way that people will be able to listen. But it's something that can happen when we're doing. So what we will then do is to check for the announcement effect, control for the news exposure, so if there is a link, so do announcements have an effect? Do announcements perhaps trigger more news, which would be already a good story to this? And then also, so this on the mean, and then also look whether this higher precision, so getting something from the central bank, then improves the variance, the disagreement, which are of course also important aspects of communication. It's not only affecting mean, bringing people together, agreeing on something, of course, something very important for central bank communication as well. Particularly while we are in a period with low inflation, right, quite stable inflation and constant interest rates. So this is the announcement effect. So the red line, there are two lines in case you're not noticing it. The red line is the the effect, the distribution, the kernel distribution of expectations and perceptions. The red line is the day after, the blue line is the day before. So what you see is that they're almost the same. Well, if you look closer, and you need to look very close here, you see that there is some small movement in the red line. It gets a bit more condensed, but there is little overall. Right? And this again reflects, remember, the 35% that have been affected by news. There were not so many, and if there's not much information, this is something you would expect, that the announcement does not change the world as such. The important bit is now, do news. If somebody has heard something about the Fed, the Bank of Ukraine, does this affect then their expectations? And hopefully it should. And if you do this, so this is the same graph, same current distribution, same variables, and now we have news and no news. And suddenly you see a huge difference in the kernel densities. What you see is that they're getting more mass at one point, so they're moving together, so all the extremes, observations are reduced, so you're bringing people together, and they are getting to a closer or a lower expectations or perception. So there is something happening, but it's not obvious that when you look at announcement and pre-announcement, post-announcement, that you see it. And this is basically reflective. You've done a regression, so we take all the data, account for all the demographics, announcements, news fed, you see, well, there is an announcement effect, it's just not significant. However, if you account for any news heard, you see that there's a substantial effect, and this effect tells you your expectations go down by roughly 0.25% or 0.5%. They get reduced by 0.5 to 0.3% when you hear something. Is there a difference post-announcement, pre-announcement? And indeed there is. Remember this share, this A being affected is really, really important. So we checked whether you hear more news after the announcement. This is what the table tells you. Before the announcement, there's like a 30% probability that you hear some news, or 30% of people report that they hear news. After the announcements, it's 40%. So announcements do something good by increasing the awareness by 10%. Okay. And if you've done this in a bivariate probe it, the same happens here, so just a more precise estimate, roughly 10% increase in the probability of getting news about your central bank, getting more information, better information. Does announcement has an additional beneficial effect? Well, we test this by interacting news and announcements, so getting news unconditionally reduces your expectations, but getting news after the announcement amplifies the effect, at least for inflation, perception and expectation. So this kind of reflects the higher precision after the announcement. Now we know what's happening. Now the Fed, Bank of Crime, makes it more clear. So when I hear something after the announcement, it's even better for me. Okay, I adjust strongly. The question now is stronger always better? Well, obviously not. So you need to come up with some kind of performance measure. Do we get better in terms of our expectations and perception? And this is what we're doing in the next slide. So we calculate the average perception error, so the difference between your perception of inflation of the last 12 months against the CPI inflation, which is called APE, and then we calculate the expectation gap. So what's the difference between your expectations and the expectation of the professionals? And ideally, we should also observe a negative coefficient so that this gap narrows down. Then we would say it not only affects us, but it also improves the expectations. And this is, of course, an important takeaway. And this is what we get, particularly again for perceptions on inflation. It goes down, particularly after the announcement. So this after announcement has an impact. For expectations, it is negative, but not significant. Almost done. Then we could look at the variance. Remember, affecting the mean is one thing, bringing everybody together is a second dimension, which is important. We saw from the kernel density plots that news are doing this, bringing people together, and this is reflected in this table as well. You see 0 is no news, 1 is news, and you see all the variances are going down. Does announcement do anything on top of this? So this is basically taking all the people that receive news and then again comparing, do they receive the news before the announcement or after the announcement? And you see, well, there's not a big difference except for past inflation. Past the announcement, the effect is even stronger. Same with confidence, nothing new, and of course it reflects some kind of the variance. With news, my confidence arises in this type of expectations I'm having, and perhaps I'm then acting on this. Little effect, little additional effect after the announcement. Then you can, of course, question, well, does a press conference actually, or do we need a press conference at all? Right? As Eryk said, we came a long way from just saying nothing, then saying something about the interest rate, to where we are with having press conferences, Twitter accounts, and all this stuff. So the question is, should we just announce an interest rate or do the press conference? And given that we're in the Fed, we're looking at the Fed, we have months where there is no press conference, and the following month there is a press conference. So we can compare what is the value added of actually talking to people. And this is just a rough estimate on this. So this is the estimate on how much more news people receive. And you can see with the announcement almost the same number. It increases by 10%, so this is reflecting the other estimates, but having no press conference reduces it by the same number. So all the positive effect of informing people comes basically by having a press conference. Okay. Of course, this identification is not perfect, because perhaps there are some, at least with some central banks, there are some special events or special reports linked with the press conferences, but I guess this gives quite a strong evidence how big this effect is having a press conference, that more news is distributed, and of course this is very beneficial. Okay, then we did some robustness and extension, but I skipped this. To conclude, and hopefully be on time again, we show that central bank communication matters for consumers. This is something we hoped for, we wished for, but now we see that something like this is happening. We highlight that it's not as trivial as doing it for professionals, because people are just uninformed, rationally inattentive, and rightly so. They have other things to consider, they have limited capacity. Therefore, we need to highlight, besides informing people what they are doing, also attracting them or reaching them. This is an important bit, reaching them, that then they can adjust their expectations. If they adjust their expectation via news, we see that it improves the quality of perception and expectations, so they're not only moving somewhere out of space, they are getting really better, which is great, great to see that communication is working. It increases their confidence, which I guess is also good, and reduces dispersion. So this is all good. And then finally, we also provide some evidence that holding a press conference instead of just announcing a target, announcing a number, has value. Thank you so much.
Thank you for a very interesting and timely presentation. And the next discussant is Carola Binder from Haverford College.
Hi, thank you to everyone for coming, and to all the conference organizers and hosts for having me. I'm really happy to be discussing this very interesting and ambitious paper. You can see that they spent several years conducting their own survey to collect some data that helps us answer questions that otherwise we just don't have the data to answer. So yeah, the benefit of using this web platform for their survey is that they can precisely choose their timing. They conducted these surveys in waves occurring 2 days before and 1 day after each of 12 different FOMC announcement events. And this allows them to rely on an identification assumption that says that any change in mean response from the first wave, the pre-announcement wave, to the second post-announcement wave should be attributable to that intervening event, the FOMC announcement. So this lets them run these two types of equations. These two types of regressions are well identified. I'm using my own variable names here, but n is this dummy variable saying, did you hear news about the Fed in the past week? And A is the announcement dummy. Were you taking the survey after the announcement? And in the second equation, y is just some perception or expectation variable, your expectation of inflation or the interest rate. So because of the timing of the surveys, they can have causal interpretation of these coefficients alpha 1 and C1 on the announcement dummy. And what I see as their two main findings are actually quite different than the conclusions on the last slide of the presentation. So the first main finding is that alpha 1 is greater than 0. In other words, that the announcements affect and actually increase news that people say they've heard about the Fed. The second is that they fail to reject the null hypothesis that C1 is 0 for any of their expectation or perception or confidence outcomes. So my interpretation of this is that the announcements do not have an effect on consumer expectations or perceptions. And this is in part of the intro. So the announcement of events have little measurable effect on average beliefs, but they make people more likely to receive news about the central bank's policy. So in this discussion, I'm going to first talk about the announcement events and their effects on news. That's, again, the results of equation 1 there. And then I'll talk about effects on expectations, perception, and confidence. So the fact that C1 is 0 in equation 2 is an irrelevance result that corresponds to a proposition, the main proposition in the author's theoretical section, and I'll discuss that a bit. But as you might have noticed in most of the paper, rather than focusing on equation 2, which is well identified, they focus on equation 3, which includes not only A as a regressor, but also N, and in some cases an interaction term of N and A. And this poses identification problems because the quasi-experimental setup they have only means that A is exogenous to the outcome of interest Y. As we've seen, N actually depends on A, and also N and Y might be correlated for other reasons, so we can't have any causal interpretation necessarily from equation 3, and I'll actually provide some simulation results related to that. Okay, so the estimates of news coverage so that about 9 percentage points more people hear about the Fed after an announcement. The timing of the survey, remember, it's 2 days before and 1 day after the FOMC meeting on a Wednesday. And they ask, during the last week, have you heard any news about the Fed? What did you hear? So during the last week, for the first wave of the survey, that's the blue bar. So the last week corresponds to day T-9 to T-2. And the second wave occurs on day T+1, so that's news coverage T-6 through T+1. So there's some overlap there. So they're both, maybe in some cases, just reporting about news from T-6 through T-2. And here, what I've done is actually collected some data about newspaper articles before and after 3 different of the FOMC meeting dates that they consider. I went to Nexus Uni, which is like a database of news articles, and this is the number of US newspapers with an article that mentions the Federal Reserve. And as you can see, about 3 days before the meeting, news coverage does start to rise. It peaks the day after and falls again. And so the people in the first wave are reporting news that they might have heard around here, and the people in the second wave, news around here. So they might even be underestimating the effect of the announcement on news because both are experiencing some of this higher coverage, and neither are reporting this increased coverage that occurs 2 or 3 days after. But you can also see that there's heterogeneity within these different announcement events. So the 3 that I've selected, the green line, the highest line, is from December 2015, and that meeting included a press conference and the Fed's first rate hike in many years. Below that, the orange line was a March 2016 meeting, which had a press conference, but no change in the interest rate. And the lowest one was the one meeting that they looked at that had no press conference. It also had no interest rate hike. And there's actually more difference between the meetings with press conferences with and without a rate hike than there are between the meetings with no rate hike but with and without a press conference. So these announcement events that they look at, 4 of them have a press conference and a release of the summary of economic projections and no rate change. 7 of them have the press conference, the release of summary of economic projections, and a rate change. And the one with no press conference also has no summary of economic projections and no rate change. So we have several things going on in these announcement events, and we can't necessarily say that the press conference itself is doing most of the work. It seems likely, I mean, they interpret that holding a press conference has remarkable added value. This is consistent with another paper that I have looking at news coverage across different media platforms before and after different types of Federal Reserve communication events. However, we can't disentangle the effects of the press conference from the summary of economic projections, which is also released every other meeting. And more importantly, I think, is that since 2011, the FOMC has announced its major policy changes only at meetings with press conferences. And so markets and the press therefore tend to overlook non-press conference meetings. Even there's a newspaper article talking about that. So that means that now the Fed is going to start doing, or maybe it already has started doing press conferences every meeting instead of every other meeting. I don't think that this actually means that we're going to get a lot more news coverage of the Fed necessarily. It's that now the press conferences are not going to be a proxy for some big policy change likely to happen. Okay, so in the author's paper, they have a proposition that says that there's 4 conditions, and a policy announcement can have no effect on average expectations if and only if one of the following conditions happens. The first is that the people who is that news coverage of the Fed is the same before and after. We know we've ruled that out. We also can rule out the second proposition because the announcements do affect news coverage. Now, but in all of the regressions that regress an expectation or a perception only on the announcement dummy, we get an estimate of C1 being 0. So we need, so 3 or 4 has to hold, or rejecting C1 equals 0 as a type 2 error. And I would like, the authors to explain which of these it is. They seem to implicitly say that it was a type 2 error, that they just didn't have the power to find some effect of announcements on expectations. Okay, so what they mostly estimate is this equation 3, regress expectations on news, announcements, and their interaction. You can actually get equation 3 by, you can combine equations 1 and 3 and show that you can still write this as a regression on A, right? Because news depends on announcements as well. So the effect, the change in Y given a change in A can be written as the sum of the coefficients from the first 2 equations, which are well identified in equations 1 and 2. However, the identification assumption that's used in 1 and 2 does not apply in 3. So their identification was based on the timing of the surveys, right? And that the announcements are exogenous, not that the news is exogenous. So I have this play model with a simulation. So suppose there's just 2 types of consumers, and I'm calling them receptive and non-receptive. And think of the receptive consumers as like Wall Street Journal subscribers. These are the people that just like read the financial news every day. And so let's suppose that the probability that the receptive consumer hears news about the Fed at any given time is just directly proportional to the volume of news coverage about the Fed at that time. And that for the non-receptive consumers, same thing, but the probability is just lower. Okay? And let's also suppose that announcements do increase news coverage, but that announcements do not affect expectations. So I'm just assuming announcements don't affect expectations. For the receptive type, their expectations come from a normal distribution with mean mu r and variance SR. And for the non-receptive, theirs are always just drawn from a different normal distribution with a higher mean. So I simulate this model using just some randomly chosen, but I think kind of reasonable parameter values. And remember, the important thing here is that I'm assuming that announcements do not affect expectations. But then I run the regressions that the authors do. So the well-identified one, regressing news coverage on announcements, you get a positive statistically significant coefficient. Here, by design, regressing expectations on announcements, you have no effect. That's by design. Regressing expectations on news coverage, you have a negative coefficient, but that's not causal, right? But again, by design, that's not causal. It's just that the people who are the Wall Street Journal subscribers have lower expectations, and they also hear more news about the Fed, even though the news doesn't do anything to their expectations. And then when you can even get the results that when you include the interaction term, it's negative and statistically significant because there's just more news coverage about the Fed after an announcement. So somebody telling you they heard news coverage is a better proxy for them being a Wall Street Journal subscriber and therefore having lower expectations. Okay. So yeah, again, regressions on news coverage may not reflect causal relationships. And regressions on A only show that announcements don't have a detectable effect on expectations or on accuracy or pessimism or what they're calling confidence or uncertainty. There are some regressions where the outcome is reported desire to consume or invest in different types of assets, and they don't report results of regressing those on A. So they regress those on N and some other variables. So it's very hard to interpret what's actually going on there. I would like to see just these consumption variables regressed on the announcement dummy, because that's the identified equations there. So in the model, they say that the reason why they expect people to be more confident after the announcement is that before the announcement, you have multiple experts reporting their opinions, and this multiplicity of opinions makes people uncertain. But they also assume that the expert opinions are independent and equally informed and rational. And under that assumption, the more of those opinions that you get, the more, the more certain you should be. Just getting more signals is better than getting fewer signals. So that the central bank signal is called a unified, precise signal, and that's supposed to improve confidence. I'm not sure that in reality the central bank signal is that unified or that precise. So part of the announcement is the summary of economic projections, which is forecasts from various FOMC participants, and they can have very dispersed views. And in fact, the SEP is kind of controversial because even Bernanke has argued that it might confuse people to see all this disagreement among the FOMC members. This is a graph I made comparing the disagreement among SEP forecasts with the disagreement among the private sector survey professional forecasters' forecasts. This is their projections for nominal interest rates. And you can see that the central bankers disagree just as much as the private forecasters. So that means it's very not obvious that the central bank, by sending a signal, should even be able to reduce uncertainty if they continue to send this kind of dispersed signal. So to kind of wrap up, my other suggestions are to regress the outcomes of interest on A and interactions of A, not with news, but with either meeting-specific or relatively time-invariant consumer-specific characteristics. Like, did that meeting include a rate change? Or how much did, some measure of this monetary policy surprise component in that meeting? Or consumer characteristics like, do they have a college degree? Things like that that are still going to be exogenous to the, given the timing of the survey. And then I definitely think they should use the responses to the what did you hear part of the news question. The respondents are all asked, what kind of news did you hear? Did you hear that rates are going to be raised or lowered? So it could be really interesting to see, did people actually even hear the right thing? They can also fill in a free response there. So did people say they heard, something that the president said, or did they hear some other kind of news about the Fed? So this is really an amazingly rich new data set. It would be great to explore things at a meeting-by-meeting level and look into more of the great amount of information that they have and some of the other questions, and I think a lot could really be learned from this. Thank you.
So maybe we can have one or two questions from the audience.
Tomáš Slečíkos in Central Bank. I would like to ask actually quite a naive question, which relates to both papers that we have heard. I'm wondering who the audience is of the inflation reports and also of the press conferences. So is it the average consumer? Because in both papers, that was the surveyed or targeted group. So is it really the average elementary school teacher or the average grandmother? And the related question is, who is the target group? So on the one hand, who is the audience, the actual audience, and who is the target group? In other words, does it really matter whether the average grandmother cares? Thank you.
Okay, so we can proceed with the answer.
Thank you for the discussion, Carola. Comments well taken. Thank you for the question from the floor. If my start with the response to discussion, I think we should say that this question 4 you said with this 1 week, we have two versions of our survey. So this question we had with the 1 week is basically the first wave. This question we changed in the second wave, which is just in the last few days. Right, so you rightly pointed out that there's this overlap if we would keep the question as it is with last week. We changed it, so every time we run this second time, we just refer to the last day. Okay, so this is, we are aware of that, and of course we need to make this more explicit. And in terms of news, there is a different news effect, even if you just split the sample. Right? If you just run it for the before people just without announcements or any interaction and run it afterwards, news has a different effect. And of course we could do a bit more to generally identify it by some, by instrumenting it or getting the announcement effect out of the news effect, but I still believe that there is a differential news effect on both samples, that this is a value add-on. And even if you compare the coefficients across the tables, you see that there's not much change in the announcement effect, but it's well taken again. Regarding the question from the floor, I mean, the target group, I think you need to ask central bankers for this. Regarding our audience, I can make a more precise statement about this. It's just the general population, a representative population. I still believe this is it's value added to inform everybody about future interest rates, future prices. The grandma or the investment broker, I think, but perhaps marginally the grandma doesn't have so much assets at hand to move in and out, but still for personal well-being or for the generally welfare optimization, it's, I guess, a benefit of informing as many people as possible. So I think we are working here in the right direction. Thank you very much.
Thank you. So please join me in thanking Michael. And so now we'll have a coffee break and we'll resume in 11:30.